Kia ora, I'm Nadine.Higgins and welcome to your personal finance podcast, The Prosperity Project. On this podcast, I'm on a mission to empower you financially. I am a columnist and a journalist, an investor, a financial advisor, and the mum of a toddler. But I do not claim to be the font of all knowledge. I'm still figuring it out too. And that's why I'll be bringing you the experts and mining their big brains for all the things you and I need to know every week. Today, share markets have been like the Wild West this year, and we're told to buy the dip because that's when shares are on a big briscoes-esque sale. But before you know it, you've blinked and the dip is done. So if you're just getting started dabbling in investing, what do you need to know about the mechanics of it? Joining us today for a bit of a 101 is the co-founder, director and 3EO of Sharesies Leighton Roberts. Kia ora.
Kia ora.
It is a bit Wild West at the moment, and how you view that probably depends on where you are in your investing journey and who you're listening to. But I'm wondering what you guys are seeing. Are you seeing more people either selling out because they're scared or trading because they see opportunity?
Yeah, maybe first it's helpful to know a little bit about the sort of buckets of types of behaviour we see at Sharesies. So the first one is we have a cohort of a few thousand people, which is quite small out of the 800,000 who are active traders. And I think they are quite active at the moment. And when things are highly volatile, they tend to be. And then we've got our largest cohort, which is what we call dollar cost averages, which is the same as most people with their KiwiSaver. And that's people who are investing regularly into the same types of investments or funds and a little bit indifferent as to the price on that. So by and large, they just continue to do that regardless of what's happening with the market. And then we have another cohort of people who are maybe a little bit more deliberate with the times. Maybe they get a certain amount of money every now and again, and they come in and they put that in. And those people we tend to see we don't see a lot of in times like this. So this is maybe the audience that sometimes we hear more about, like choose to put their head in the sand or something like that, which isn't a terrible strategy at all. It's not one I personally prefer to just face it and have a look at it and see what's going on, but that works as well. So in summary, we right now are seeing our dollar cost averages just continue on through and really stick with that, and that's same with our KiwiSaver customers.
It's interesting, and I wonder how many people understand the concept of dollar cost averaging, because we often talk about it being just like what happens every month in, month out with your KiwiSaver. But is that cohort of people who are just regularly investing, is that over time growing?
Yeah, it's very large, like over 10% of our customer base.
Wow.
So I would guess there's more than 100,000 people on the platform doing that. So it's a big number of people, and they do all sorts of different amounts. So you get people from doing thousands of dollars a month through to, I know there's a lot of people who do like $5 a day, and then everything in between. Part of this is what the platform was built for. I'm personally a dollar cost averager, if you ask what my investment strategy was. Tend to try and be an opportunist every now and again, but by and large, that's the strategy I use. So that's sort of how we built the platform. That's why the auto-invest type features are very popular.
And so that is just picking a particular fund and a particular amount and a particular frequency and kind of setting and forgetting?
Yes, setting and forgetting. And people do come in and check it regularly. I think that's quite common. And there's still that fear. A lot of people think about the fear of investors. We don't see it that much. I think by and large, people do come in and check, and the education is much higher now through lots of reasons. KiwiSaver being one. Sharesies is now 8 years old. Like, the access is much stronger. There's been a lot of investment into education. But one of the key messages I'm always trying to get across in these times to people who might be new, and we did mention this being 101, is that dollar cost averaging as a strategy is a very poor strategy if you only invest when markets are high. The whole idea is you take the average price of the market, right?
Because otherwise your average is always high.
Exactly. And therefore you're buying in. So that's where the sayings of the market is on sale and that type of thing come in, because the reality is you're buying exactly the same things you were buying last week, but they're cheaper today.
So consistency is key.
Consistency is absolutely key.
Yeah. Let's talk about going international, because obviously, the New Zealand market in a global context is tiny. So if you want to look at the US or Australia, there are so many more options of things to invest in. But what do you need to know about investing beyond our shores? One of the first things that comes to my mind is the currency.
Yeah.
How do I invest in a different currency, and how do I account for the fluctuations in that?
Yeah, well, so I guess the first thing is you are still just investing in companies or funds overseas, and platforms now do make most of this pretty easy to get around. But one of the considerations you do, as you touch on, is you're now dealing with a different macro type situation as well, and that can impact the pricing.
Politics.
Yes, and very relevantly, politics, which flow through to things like currency. And currency becomes like, when you invest in the New Zealand market, you basically are just investing in the New Zealand dollar, and you earn in the New Zealand dollar, and you pay your mortgage in the New Zealand dollar. So it's not that much of an impact, right? But
yeah, so it just takes one variable out of the equation.
Exactly. So, but when you're overseas, you are investing through different currencies and have that additional level of volatility, which can work in your favor or against you. Like, for example, a lot of people, whilst the US markets dipped over the last year or so, that was somewhat offset by the New Zealand dollar performing weaker over that time as well. So even though the price of the companies in the US was going down, the currency was stronger against our currency, so it offset some of those losses. So currency is a consideration, unless you're going into a country where you don't believe in the value of that currency into the future. If it's just too disruptive from a political point of view, we've seen these, the Zimbabwe type stories and stuff. Then it doesn't have to be a massive consideration. In fact, most companies you invest in New Zealand, because we do a huge amount of exporting, also
exposed
have material exposure to currency as well.
But from a practical point of view, when I'm on the Sharesies platform, do I exchange my money first and then buy my shares? Is it hedged? How does it work?
So you have the option to buy, to either move the money over first or to invest straight through, basically. So, and most people will move the money into a different currency first, and there is a fee for that. So that's another consideration as well. There's always a fee, but once you have it there, you don't have to move it in and out if you are moving money around. So often, if people are paid dividends in US dollars, they'll just reinvest that straight away as USD or something like that. So they don't actually, you don't have to wear those currency fees multiple times.
Yeah, so there's a fee for exchanging it, and is that just done at whatever the exchange rate is at the time you do it?
Exactly, yeah. So we're running we're having data feeds which are basically showing, the term normally uses interbank rate, which is showing the difference between the buy and sell prices of buying a currency or selling a currency, and we display that to you in real time. So you do have choice on that, and there are people who follow that currency and try to be opportunistic on that as well. Mm-hmm. The only thing I'd say for newbies to investing on that is it's worth normally investing on working days, funnily enough, because on the weekends when the markets are closed, your spreads get wider, and a spread is that difference between the buy and sell price.
Okay, you might need to explain the relevance of that, though, if we're brand new to investing, what a spread
So there's a spread in pretty much everything that we buy on the market, and that spread is that if I'm willing to pay $1 for something, then you might be willing to sell it for $1.01, and then as soon as we agree on a price, then we hit a price, but at all given times there's two sides of the book on the market, so your buyers and your sellers, and we're always just waiting for those to hit. And the same thing exists in currency books. So you have banks normally are making a price for you, so a price they will buy it and a price they will sell at. Markets are open most of the time, but when they're not, to allow for that risk, those spreads, or the price they buy and the price they will sell at, just widen a little bit.
Let's also talk about tax, because I think someone described to me the other day that the US tax department makes the IRD look like a kitten. And so what I wondered about was how taxes work if I'm earning dividends from US investments, or do you take care of all of that for me?
Yeah, so Sharesies is something where we have an authorization as a QI, which means qualified intermediary. So there's a lot of jargon around this, but it's basically an authorization from the IRS to withhold tax on a customer's behalf in line with their treaty agreement. So we have these treaty agreements with different countries and I can't remember exactly what the New Zealand one is, but if you use the treaty, then effectively you're paying less withholding than what you would be if you don't use it. So we do manage that. So
it's to avoid getting taxed twice, like in the US and then again in New Zealand.
That's right. Yeah. So and between this, so we do that, but there's an additional piece of tax. The second part we'll do is manage the difference between that and your withholding tax. So and that's like a normal income tax that everyone in New Zealand pays on things like dividend income. But there's another tax in New Zealand, which some people may know of, which is called the FIF tax, and that's the foreign investment tax, of which most countries are part of, but there are some exempt companies in Australia. But within this FIF tax, it's based on if you've invested $50,000 or more. So it's from your base, from the amount you invest. And from there, it opens up a world of complexity, which is probably more than we need to go into right now. And at that point, often worth seeing an accountant. But again, we do help with reporting and stuff for that.
So basically, if you're under that 50,000 level, which you'd assume most of your newbie investors probably are, it's less complicated.
Less complicated. And as I say, at any stage in this, Sharesies at least, and quite a few other platforms as well, will help you through that.
Yeah, we're going to talk a little bit more about the fees and how to get started, but we need to take a quick break, so we will be right back with Leighton Roberts from Sharesies just after this. Welcome back to the Prosperity Project. We're talking about investing with the co-founder of Sharesies, Leighton Roberts, and I want to talk a little bit about fees, because obviously you guys are the intermediary, you need to be paid for that work, but I'm keen to know how it works. If I'm investing $100, as I understand it, there's a fee of around 1.9%, is that right?
So the fees is worth looking into based on what your plans, what your goals are. And so at Sharesies, we offer two types of fees. One's is like subscription fee, where you get like a certain amount you can eat, I suppose, for and that tends to be very economically viable for people, and a lot of people will optimize to those subscription fees.
So is that if you're doing quite a bit of trading, it makes more sense than just paying individual trading fees?
That's right. It doesn't have to be a lot. So if you were to put like $100 a week in, for example, you would be most likely better off just paying our $3 subscription fee than doing it by trade. So, and the way our transactional fees work is you pay 1.9% up to a cap. So all of our brokerage fees are capped. So, and that can vary based on what investment or exchange you're using. So whilst it can be a little bit complicated to speak without knowing exactly what the person's circumstances listing are, our app, for example, is very transparent on exactly what that is. And there is like a pricing page which hopefully spells that out pretty easily. And of course, just a question away to our team.
And is there quite a lot of pressure for you to keep those fees competitive now that there's lots of players in the market saying invest through us?
Yeah, there is. And we've always aimed to be very competitive in fees, and that remains to be true. And we very much are. But as you say, you know, we do need to make money as well. But by and large, the strategy of Sharesies is to encourage people in the dollar cost averaging way, and that is how most people use the platform. And as a result, that's specifically what our plans have been built for. Right.
So is it, if you're doing regular amounts into the same fund, it's cheaper because you're just repeating the same thing month in, month out?
Basically, yeah. So, and it's a little bit less flexibility, I suppose, because you're using the auto invest, which just means it's going to go through at any point in the day once your money arrives, more or less, as part of an auto invest. But we also, within the plan, make some available for you to pick and choose what you want to do as well.
Yeah. What about fractional investing? This interests me because I guess the buy-in price, particularly for some of those big international shares, can be quite high. Like owning one share, unless they've done some sort of share split, can be a lot. So talk to us about why you might look at fractional investing. Is it a way of diversifying, perhaps, when you haven't got a heap of money to invest?
Yeah. So firstly, it is, and it's now. It's basically commoditized in that the US market definitely is fractionalized. Almost doesn't matter which provider you go to in the US. That's not necessarily true on this side of the world, but we do have a lot of companies, and Sharesies included, that do offer fractional. And then Sharesies is, as far as I'm aware, if not the only, certainly one of the only to fractionalise the New Zealand market and the Australian market. Now, the reason we did that is because early customer research really showed that people wanted to invest $100, they didn't want to buy a $95 share. So, which is more how our KiwiSaver behaves and how we go and invest in our KiwiSaver. So that's why we did it. And technology now, as I mentioned earlier, basically commoditizes that, and that fractional is very much a normal thing of investing. In fact, it's how most people experience investing these days.
Really? And what's the benefit of doing fractional shares over just buying an index fund, that might follow the top 50 or the top 200 and diversify that way?
Yeah, so that's up to, that's a great example, right? The ETFs and stuff do offer fractional shares. It's effectively what you're buying. It is people who just want to choose more specifically. When you talk about some of these large shares that might be thousands or hundreds of thousands of dollars, but you want to specifically choose that company, then it makes a lot of sense for people doing that. It's less of a constraint for people if they're buying a $5 share or a $10 share, but still it means if you want to invest $10, you don't end up with just a bunch of lazy money sitting around. So you're still exposed to the market with all of that cash.
So is it more a way of like having a DIY basket of shares than if you just invest in an ETF
the big thing is you're putting all of your money to work at the same time rather than just having. In fact, when we first started Sharesies, we didn't have fractional, and everyone would get change. So you'd invest $10 and you get given $2 change or something like that, right? And that's still how it works on a lot of more traditional platforms. In that, if you say I'm going to invest $100,000, you'll probably invest $99,000 something. So you always end up with this niggly amount. But it just got to the point with. The big thing is technology enables this not to be a problem. Like the technology does not care if it's buying 1.13 of a share or if it's buying one share. That's basically why that's much easier. Now, there are some considerations, but they're fewer and fewer. But in New Zealand, for example, you can't transfer. At Sharesies, your shares are held in custody for most customers. Some people, or the more traditional way has been to be held on something called a CSN, which is a common shareholder number. Mm-hmm. And you can't move fractions of shares onto your own CSN. You can only move whole shares. But at that point, you can just sell it. It tends to be pretty small. So
just talk to me about the difference there. Is that the difference between owning a share directly and then owning a share through an intermediary? So if you've got a custodian, does Nadine Higgins own the share, or does the custodian own the share on my behalf?
Yeah, no. So the customer, Nadine, always owns the share, right? Is the ultimate owner of the share. And Sharesies, or whoever the custodian is, and most investments around the world, actually, but true for New Zealand too, are held in custody, mm-hmm. whether that's through your KiwiSaver. In the US, it's just far more common to have a custodian. Mm. There's a lot of large custodians in New Zealand and Australia, of which Sharesies is a large one now too. But it basically means that we can help you with a lot of the administration. So you still have all the rights that you have with your shares anywhere else. You still own them. Fractional can sometimes make this a little more complicated because you only own a fraction of shares. So how much of a right do you get? But normally even that stuff works. Like we pretty much make everything available for most people.
Are you talking about there if there's like a rights offer?
Yeah.
Or if there's something that needs to be put to a shareholder vote? How much of a say do you get if you only own 0.003 of the share?
Yeah, well, and all of that it works on a pro rata basis. So
the math's going on in the background.
Yeah, it just works. Yeah. So if you get a rights issue and you own half of a share, you will get half the access to that right.
Okay. There's a bit of terminology to get your head around with finance in general, but particularly when you're dealing with the markets. And so I wondered if I could just talk about when I come to want to sell my shares or I want to buy my shares, there are a couple of different options for how you go about it, right? You've got the limit sell order or the stop loss or the trigger buy order. And a lot of people would be like, well, what's that when it's at home?
Yeah,
Can you talk us through our options?
I mean, there's a lot. Like, again, I'm a dollar cost averager, and
so it doesn't matter.
And it doesn't matter to me. I buy what's on market at the. There's a lot of what we call liquidity on market, and that is people they're trading the price regularly, trying to get better and get better outcomes, right? And what that results in actually is the spreads I touched on much earlier being normally quite narrow, and certainly for very big companies. So the difference between what someone is prepared to buy a share for and what someone else is prepared to sell it tend to be very close together most of the time. So if you want to use different things, like a lot of people, you have a target price that they'd like to sell something for, and then they place like a limit sell on that. So it means that if it hits this price, it will sell or limit buy. So if they have a target price they'd like to buy something for, so say Auckland Airport's trading for $2 today, but I only want to pay $1.95 for it because that's what I've determined the value to be, then I can place an order that says, hey, if it hits $1.95, then I will buy. So you do have all of these options. The best way for all of this actually is not to feel like you need to know it. And one of my favorite, like the number, in fact, I had this conversation with someone on the plane today. I was actually sitting next to Paddy Gower on a flight this morning, and we talked a lot. And
that doesn't sound like Paddy.
We were talking about this, and he started with saying, "I know nothing about investing," and then proceeded to tell me like everything he knew about investing, which was a lot, And it's just amazing how often I get this like, "I know nothing about investing. I use Sharesies. I just put $50 every week in an auto invest or something like that." And I'm like, that is a great strategy. It's a really good strategy, and you know exactly what you're doing, and you actually know about investing.
Yeah, so people think of it as, I'm a bit lazy or I'm cheating, but actually it can be the smarter alternative.
Well, it's a very tested strategy. So the thing about growth in investing is what we're doing, is we're trying to invest in things that will achieve growth and ideally outperform what we would just receive in a savings account or something like that, right? And the price of that is volatility. So you have to accept that there's going to be ups and downs, but the prize at the end is that it will have grown more than what it would have somewhere else. And as soon as people start to realize that that's the price of growth rather than like a penalty you pay for it or something like that, then people can get a lot more comfortable in it, and then you can start to be not that unhappy that you get to buy prices at a bit lower, because you get, hopefully you'll have some choice. And this is about how you manage your finances more broadly, that when you sell, it's not urgent. And the only other thing I'd say on this is there has been a bit of behavior, including my own family, of people who just, a lot of people don't actually access this money for the first time until retirement, particularly in KiwiSaver. And most people will also, or a lot of people will just sell the whole portfolio then, but you don't need to, right? And you can.
Because you don't spend the whole lot the day you turn 65.
Exactly. So, and you're unlikely to just need however much that money is on the day. You will hopefully be able to weather a few storms in that as well if there's some. So you don't need to put it all in at once, and you don't need to take it out all at once. It's a long game.
Yeah, and I know during COVID, a lot of people behaved in a panic and moved to conservative funds and all of that. But do you think that we're maturing a little bit in our investing behaviour?
Our data certainly shows that we are. Like the huge data set now of people and different types of behaviour. And, right now, for example, as you touch on, the last 3 months markets are down like materially, right? And the behaviour, the education around that, we now have a culture, I think, of speaking about money and of it not just being property. And New Zealanders have pretty much always been pretty good property investors in that people have bought them and held them for a very long period of time, and they've made the most out of a bit of leverage, And now I think people are becoming pretty good investors into other asset classes as well. KiwiSaver is absolutely helping with that, and so is easy access to markets.
Well, I was going to say Sharesies has helped with that, because I know when I started out as a business reporter, earnestly intoning, the latest share market numbers, a lot of people were kind of like boring, whereas now people seem really engaged.
Yeah, and like I love that it's becoming a conversation now, and places like Australia and America that where you can see they're probably a little bit, well, we know they're a little bit ahead of us on this game. Like very heavily invested generally into equities in Australia. A lot of that's because of superannuation. But there's no shame in talking about what's happening with the markets. And again, I was lucky enough to have someone tell me a story today about their 23-year-old niece who is like regularly talking about what's going on in the business at some of the places she's investing in. I think the specific example I touched on earlier was at Auckland Airport, actually. But it's really, really cool to see this, because that's just an additional knowledge, and then we can all learn from each other. And ultimately, like more capital invested in these assets around New Zealand will be very good.
Just finally, what is, and I use the word advice cautiously because I don't mean financial advice.
Yeah.
I just mean those who are dabbling in the market or well invested in the market at the moment, what they need to be thinking about, given there's so much noise.
Yeah. So there's a really cool Jeff Bezos quote, which is he often gets asked what will be different over the next 10 years. I think it's Jeff Bezos, but what's going to be different in the next 10 years? And his response was sort of like, well, what's going to be the same is maybe the more important question, because behind that you can invest in things that are going to be valuable, right? And also, humans, whilst we really like stability, and that's what we're looking for, the certainty in the market, actually, we're just like these changing creatures and nothing, we're always hit with. A colleague of mine, Susanna, has just been writing about how the term unprecedented has become very much precedented. and that's what it is, right? But in reality, even though like right now we're in a market dip again, and it's significant on portfolios, we have been through these market dips before. The reasons behind it are different, and everyone keeps saying it's unprecedented. We haven't seen tariffs like this since the early 1900s and all of that, and that might be true, but every time this happens, it's because of something that we did not foresee. Mm-hmm. Otherwise, we wouldn't have been surprised by it. So the big thing is I can think is like, well, are we still likely to live in an environment where people are working for companies and that companies still need to make money? And my personal view is yes, in which case then the companies are still going to be good long-term growth assets, and most people are still going to need the companies that pay their salary to ultimately pay their mortgage, which enables them all other sorts of things in life. Then I think we can take a lot of confidence that whether it's today or tomorrow or 1 year or 5 years, if we take a long enough view, that these investing strategies will continue to be great long-term builders of wealth.
It's been really interesting to talk to you, and I think maybe we need to talk to you again, because I've got some other questions about starting to get investing for your children, which is something I'm starting to think about. But really appreciate your time, Leighton Roberts from Sharesies. Thanks for listening to The Prosperity Project. You can follow this podcast on iHeartRadio or wherever you get your podcasts, and please do chuck us a rating or a review while you're there. For more personal finance and business content, head to nzherald.co.nz, and please do feel free to get in touch with your questions and your stories. nadine.higgins at nzme.co.nz. A reminder though that this podcast is informational only, and nothing we say here should be considered personalised financial advice. But also remember that while listening to this podcast is hopefully going to be additive to your financial knowledge, and that is fantastic, knowing stuff doesn't create change, doing stuff does. So what action are you going to take today to make your life more prosperous? My producer for this episode is Ethan Sills. Sound engineer is Richard Martin. I'm Nadine Higgins. Thanks for listening to The Prosperity Project.